I don't think that central banks have adjusted very well to the hiccup of globalization. You know, we have a world that has excess capacity, and the central banks keep throwing them lifelines, whether it's in the form of manipulated FX, rates that are probably too low, purchases of paper to keep sovereigns looking healthy, and of course all their holdings, whether it's our central bank or others. So in the end, how are we going to delever? How are we going to clear out the excess capacity? How are we going to see goods prices move up, which the Fed and central banks want, when the very nature of what they're doing prevents that healing?
That's a great question, because monetary policy worldwide, including here in the United States, is leading to a distortion in the way monies are distributed and asset allocation, inflating the price of securities or anything that trades, including commercial real estate. And then you are very hesitant to try to take that away for fear of volatility or for fear of a downside slippage that could infect the economy. And you know, I've said this over and over again, Rick, the Fed has the markets on Ritalin, trying to keep the mood very smooth, keep volatility down as much as possible. As soon as they hint that they might remove that, then they create the problems that they're afraid of. So they box themselves into a corner, and the real art will be to see how they manipulate or maneuver to get out of that. It's not clear how it's going to be done, but I think it should be done. And the sooner they begin to act, the better.
You know, but the problem is, and your first word was probably correct, manipulate. Listen, the problem with manipulating is, you know, Richard, at one point in my youth, I had a mustache, okay? And I tried to trim it, and I didn't quite like it, and I trim it a little more, and I trim it a little more, and pretty soon I had no mustache anymore. Okay, how is the Fed and central banks going to know when to stop, when to let things happen? They seem to want to over-communicate, but their communications are in the form of, you know, here's what the market's going to look like, here's what we think our dots in the economy and growth are going to be. They're never correct. How are we going to see the reins slow things down when there's no indication they want to address the real fear, which is the level of markets and financial assets?
Well, to me, that is the concern. We have levitating markets, and yet we have analysts, including our good friend Steve Leisman, who puts up a bar chart of who's dovish and who's hawkish. And this is theater of the absurd as far as I'm concerned. Not Steve, by the way, who's my dear friend, but just the idea that so much time is spent. And even yesterday on this program, or the last couple of days, what's more important, top line growth, bottom line growth, or the central bank, the Federal Reserve? And the agreement seemed to be, all the analysts you all had on, it's the central bank. That's not what central banks should be doing. Central banks should not be driving the markets. They should be assisting the real economy. And the real economy, both domestically and globally, compared to the last meeting that was held, is doing much, much better in terms of employment, in terms of stability overseas. The Argentines have come back to the market. The Chinese data is better. The Brits, by the way, just issued a 50-year bond that was 4 times oversubscribed. And it only is 60 basis points above where the 10-year Treasury is trading. These are very robust markets. So, you know, I would take advantage of that right now. And I would be prepared when they move, and I hope they move sometime in June, if they're, or indicate some wording today, there'll be a settling in of the marketplace. There will be a correction. Suck it up, deal with it. That's reality.